Hello guys, welcome to my YouTube video. I will be discussing or sharing my lessons learned so far in Forex trading. This video is ideal for guys who want to get into Forex trading or guys who are starting out, maybe guys who started out earlier but something's not working out. You could just simply make reference to this video, you could find something useful. And this video centers on two pieces. Number one, psychology in trading and also competence in trading. These are the lessons I've learned so far since I started trading. I'd say consistently I've been trading for more than 1 year now, inconsistently for about 4 or 5 years now. But I'm only picking the lessons I've learned the last 1 year. So I'll start with the first lesson: be patient. The Forex market is a wealth creation and transfer mechanism that rewards the patient and the competent. And I learned this lesson the hard way. You get into the Forex trading business, and something within your psychology or your attitude, your mental orientation tells you that you can make money fast. There are people who can make money fast, but they have had years of experience to get to the point where they're able to make money as fast as they can, and you're not at that level yet. Be patient. Oftentimes, the market has taught me just sit and wait. Let the market come to you. Let the market give you information. Don't chase the market. You'll hear Forex traders telling you there's something called fear of missing out, FOMO, where you always want to be in the next trade and the next trade and the next trade. But in the long run, you find you have more inefficient trades than efficient ones. So generally, I tell you, be patient. Even if your friend is making 10 times what you're making, be patient. We do not have the same journey. So number two is understand where you're trading and set realistic goals, long-term goals, of course. Forex is a long-term game. Keep an internal score and avoid the need to compare your growth with other traders. Keep it small, keep it simple. Think of Forex trading as a wealth creation or a business. And this is really, really important, and it's also linked to number one. This is a long-term game. There's a statistic I keep hearing that 90% of traders don't make it beyond the 90 days. You keep hearing it until the day you get into this thing. I remember when we were listed as strategy providers by HF Markets. My current broker, one of my brokers, is HF Markets in Kenya. We were listed as strategy providers. And I want to use a real life example. One of the guys who was sort of my competitor was posting outrageous returns. By the time I'm posting 40% return, they're doing 260% return. Of course, on paper, they're beating me. But here's the thing. What was your goal? If your goal was to make 10% per month and you've made 11% that month, it does not matter whether your friend has made 40% or 100%. It does not even matter. If your goal was to make $20 a week or $20 a month and I have made $2,000, your goal was not to keep up with me. Your goal was to keep up with yourself. And that's why I ask traders, and this is something I teach in my first class. Like the first class is psychology and mental orientation. How to position yourself before you start. Have realistic goals. Your goal could be, I want to retire in the next 5 years with 1 million Kenya shillings in my bank account. So if you break that down in 5 years, that's about 200,000 Kenya shillings per year. If you break it down for the 12 months, it may come to around 18 to 20, 18,000 thereabout. So if your goal is to make $180, approximately 18,000 Kenya shillings per month, it does not really matter whether your friend is making 400,000 Kenya shillings a month. If you're making or you're keeping the internal score and you're meeting your targets, you're successful. So long story short, about the 85th day, the guy who was posting about 260% return compared to me did not make it to the 90th day. I think they blew their account. So that's why I'm saying keep it small, keep it simple. Think of it as a wealth creation or a business. Consistency, success responds to consistency more than intensity. I personally trade micro lots of 0.01, and some traders I meet don't understand how I'm able to move an account from X to Y with a micro lot. But if you have attended one of my classes, and if you are one of the guys who are taking or copying my trades, you'll realize that my goal is to, number one, protect your capital. Once I protect your capital, I am aiming to make sustainable returns. And I have no problem making 3% every other month. I have no problem making 5% every other month. If you look at it from a long term perspective, we will be simply compounding what we have. And I think compounding is one of the most powerful mathematical formulas of mathematical concepts I think we've ever come across. So guys, keep it small, keep it simple. Think of forex trading as a wealth creation or a business. Number three, invest in knowledge, learn one trading style, and seek to continuously improve it and develop your edge. Why would I advise people to do this? I came across a quote, I think by Bruce Lee, that he does not fear a man who has practiced 10,000 kicks, but he fears a man who has practiced one kick 10,000 times. One thing I've learned is that we are not the same. There are scalpers, there are day traders, there are swing traders, there are position traders. Then there are people who use fundamentals, others use technical. Some people tell you I use smart money concepts. Another person will tell you I use support and resistance. Another person will tell you I use institutional order flow. Find what works for you and find it early. If you happen to try one method and you find it does not gel with you, you can go to another strategy. But first of all, understand, number one, what was your goal in the first place? What was your long-term goal? What trading style, what knowledge works with your long-term goals? You may find that you have a long-term goal and you're a patient trader, but you find that you're beginning to behave like a scalper. Oftentimes you're likely to lose your money. So what is your trading style? Personally, I'm a swing trader. And it does not matter whether I am sitting around scalpers and they tell me they have valid positions that are going to make me money in the next 1 or 2 days. As long as I know my setup has not shown me a trade setup or has not shown me an entry, then you can keep your setup. I have no problem. And number three is closely related to another point where I think I'll talk about limit the noise. I'll go back to that point. So again, find your trading style, stick to it. So continuously improve, and practice makes improvement. Practice makes improvement. Practice doesn't make perfect, but it makes improvement. And I would use myself as an example. When I started, it took me 56 weeks to double an account. Then I opened another account and it took me 16 weeks to double that account. So I could actually see an improvement where I was making less efficient trades in the first place. Now I'm making more efficient trades. They are not where I want them to be, but I am better than where I started. And that's why I think next year time like this, when I'm doing this a repeat of this video, chances are I'll have refined these lessons and I'll have, let's say, even better statistics to share with you. Number four, practice makes improvement. As I mentioned, practice makes improvement, not perfect. Make it a habit to clear your charts and analyze after long periodic intervals. You can better your skill by practicing your trading plan on many currency pairs. It allows you to appreciate how diverse the forex market is and helps you improve your analysis. Experienced traders will tell you find one pair and stick with it. Another group of traders will tell you have a basket of pairs you look at. But as I mentioned, this video focuses on psychology and focuses on competence. So if you're looking to build competence and you have learned one trading style in number three, this is support and resistance, or institutional order flows, or smart money concepts, or whatever it is you learned, practice it often. Practice it across very many pairs. It helps you validate the knowledge you have. It helps you appreciate how pairs behave. The first time I came to the market, I did not even realize that there are currency pairs that are correlated. So you find that when you're analyzing USD pairs, USD Canadian, Japan, USD Swiss franc, Mexican peso, once you analyze these pairs and you see there's a bullish move in the horizon or a bearish move in the horizon, you also know that by the time I'm going to analyze GBP, USD, Euro USD, the Comdols versus the Comdols versus the US dollar, you are likely to see an opposite of the analysis you did in the American pairs. So practice makes improvement, not perfect. And over time, you can do an analysis like I know once I do an analysis on certain pairs, I may not have to go to another pair to do the same analysis. Chances are this is likely to replicate on the other end, but I did not learn that in the first few months. It's after several months of practicing I've come to that conclusion. Number five, always have a trading plan. Your trading plan, always have a trading plan. I think this was a mistake. Sorry for that. Your trading plan, of course, should reflect. Oh, it was a continuation. I think I put the full stop in the wrong place. Your trading plan should reflect your definition of setups, entry positions, exit position, and confirmation that works for you. Please note that the U is underlined in capital. Again, this is related to number three and then the next, I think, 2 points where I'll say limit the noise. If you are a trader who uses stops, sell stop, or a buy stop, your approach to the market will be different from another trader who uses sell limits or buy limits. But the key thing would be how your setup looks like. You will go to IG, you'll go to Facebook, you'll go to Twitter, you'll go to whatever platform, and you'll see guys posting their prediction of currencies. And this is where I don't necessarily have a problem with guys who want to buy signals. Personally, I don't believe in buying signals, or I don't even believe in selling signals. And that's why where necessary, I'll post my analysis for free. For free. Just take it. But I'm not saying you should follow what I am doing. I'm just posting it. The problem with signals is that, remember I said, learn one trading style and seek to continuously improve it. I may be a swing trader. I go to Instagram today and I'm scrolling and I'll see, or Twitter, or I'll see some guys post a setup of Euro USD. They say they are long. Now, my analysis was short. Theirs was long. Now, I don't even know whether they're scalpers, swing traders, or position traders, or day traders. I have no information of even how they approach the market. Then I make the mistake of executing using their setup. If I make money, I am lucky. If I don't make money from that trade that I use somebody else's setup or trading plan, then I should blame myself. Why? If you've invested in knowledge, as I've said in number three, trust your plan. Trust your plan. I think I made a post sometime on the Euro USD on IG and I said I was fearful of making that trade. And I think towards the end I mentioned, if you trust your trading plan and you're right, you are wiser, you are wealthier, and you are confident. If you trust your trading plan and you're wrong, you are wiser. So you don't walk away as a loser, you walk away as a winner if you trust your trading plan. If you trade with my plan, if I post my analysis and you use it and you don't make money, you don't get to blame anybody. That's why I'm saying find a trading plan that works for you. There are guys whose trading plan will confine them to making 2 trades a month. There's nothing wrong with that. There are guys who have a trading plan that allows them to make 5 or 10 trades in a week. There's nothing wrong with that. Again, we don't have the same goals when you go to this market. People are different. Number 6, journal your trades. Why am I saying journal your trades? Get to understand. Yes, there was a setup, and I got into this. Position. I'll use an example where I think I made a very big mistake. GBP JPY. So this is a pair I'm currently short. I'm short, and it has not yet hit my take profit. But I enter this trade around the 164 region. 164 region would be around somewhere here. But I entered it, let's say, 22nd of October. Now, the reason I'm saying journal your trade is that you can go back to your setup and where you have entered this trade and you can take notes. And one of the notes I will take is that I did not have proper confirmation of a sell entry. As you can see, I've marked a higher high and this higher high has come from this position, but this position was not broken. So there's no break of structure. But why did I sell? So I'm journaling my trades to tell myself I failed here. I think I need to do this. I need to stop doing that. For instance, I need to stop allowing fear to control me or to approach the market in a fearful manner. The market is just giving you information. Now, fear is how you process information, or opportunities is again is how you process information. So journal your trades. Over time, you'll get to see consistency in behavior. You'll get to see that you either sabotage yourself and data will tell you. You are impatient, again, data will tell you as you journal your trades. You will get to see my confidence is improving because I am seeing I'm making lesser mistakes as I move forward. And you can see that's an evolution of a trader. So guys, learn to journal your trades. I think if you go to YouTube and search for cold water effects or phantom trading, I think phantom trading has a video on how to journal your trades. Personally, I bought a trade journal from Cold Water Effects, who had that at that time partnered with Phantom Trading. So if you are interested, check it out. Number 7, always trust your analysis. It will always work in your favor. You're better off taking opportunities the way you saw them instead of how someone else saw them. Early in the year, I remember I was trading for a client, my account and other clients' accounts. I was short on gold. Come to February, this is 2022, Russia decides to invade Ukraine. So the gold rises. I didn't see it. Again, I can't blame anybody. That was my mistake. So as gold is rising, this account is in the red. It has negative running trades. Fear kicks in. And before I forget, I'll post a video of what fear does to you when you get into this market. Fear should not have any position in your trading. My analysis tells me gold is short. The short position is going to work, but the market is currently going up. So on a Friday, I panicked. Again, I said, trust your analysis. And then, as I mentioned, have a trading plan and stick to your trading plan. So on a Friday, I think on a Thursday, I went long in gold and silver. Remember, my setup has not told me to go long. I'm simply reacting to the market. I remember I mentioned I started this video to talk about competence and psychology. So this is why I am not patient. This is why I am reacting. And I think there's an element of fear. Then I ask myself later on, when I'm in the long trade, remember I have a short position and a long position. I ask myself, why did I buy? So I closed the buy positions at a loss. The account was in Kenya shillings, so we made a loss of 4,000 Kenya shillings. The running gold trade was about negative 19,000 Kenya shillings. So on Friday, I told myself, I don't think I want to go into the weekend knowing I have a very big negative position. So I closed the negative position. At this time, the account had grown from 50,000 Kenya shillings to about 100,000 Kenya shillings. So I tell myself, even if I take a loss of 19,000, I'm positive 81. I took that loss. Monday morning, gold starts coming down. Now, as we speak, gold has come from a high of 1900. It has gone to a low of 1620, 1630, but right now it is retracing to the levels of 1800, 1700. What I had predicted actually happened. But the market has taught me a good lesson. Trust your analysis. And gold is the only one I'm talking about. There are other pairs I have gotten into, GBP, AUD. I remember even sharing with a client whose account I was trading, and I told them I got into this trade. Then I think because of it, I got out. So I took a $6 profit, only for me to realize in the end it was going to give us around $33 profit for a micro lot. I mean, trust your analysis. If you have competence, if you have built your knowledge over time, trust your analysis. And it does not matter what others are saying, just trust your analysis. And that brings me to the number 8 point, limit the noise. I usually recommend this during the last class when I'm training guys. Once the class is done, kindly unfollow me. Unfollow me, unfollow everybody else. Just follow like 2 or 3 accounts that rarely post the analysis. So the few Forex trading accounts you follow, the better. Many Forex accounts tend to cloud you with conflicting analysis that ends up watering down your analysis and overall ability to stick to your trading plan. We don't see the same things.